With U.S. equity profit margins near historical peaks, there's a widely held view that contraction is inevitable. Over the past decades, long-term reductions in both interest and tax rates have buoyed margins to their current levels. But those trends are reversing. On the other hand, analyst consensus expectations point to significant margin expansion, driven primarily by anticipated gains from artificial intelligence. Both stories can't be correct. We feel analyst expectations are too optimistic given current valuation multiples, and that rising interest rates will put downward pressure on margins, although not to the degree suggested by the current market narrative. Let's take a closer look. Despite a sell-off in most major equity indices last week, forward price-to-earnings ratios remained elevated by historical standards. This suggests analysts believe earnings and margins are below normal and likely to increase. With an expectation of 8% revenue growth and 17% earnings growth, implied profit margins are anticipated to jump a full percentage point over the next year, a substantial increase off their already near record levels. Much of this improvement is attributed to the expected efficiencies of artificial intelligence, but we feel those productivity gains are nebulous and hard to forecast, especially in the near term. In stark contrast, market pundits are painting a rather gloomy picture on the direction of margins. Empirical evidence suggests the decline in interest rates and marginal tax rates have contributed materially to margin expansion over the last 2 decades. With the potential reversal of these trends combined with the challenges of shifting supply chains and the overhead of the green transition, some suggest margins are likely to contract materially in the short term. While we think there will be productivity gains to artificial intelligence, we believe the analyst outlook is overly optimistic as it will take time for these effects to take hold. In the near term, we think the pressures of rising interest rates will outpace the efficiencies of artificial intelligence, but we do not expect a margin collapse. Any decrease will be modest and at least partially tempered by growth in the tech sector with its already outsized margin contribution. We feel there will be modest, tenths-of-a-digit declines in margins over the near term, but do not share the euphoria of analysts or the gloom and doom potential for a margin collapse.